What's going on, guys? This is Christian from Stock Hours. Today's video is going to be a little bit different. I made a slideshow for you guys, so hopefully, you guys like the setup for this video. But today is basically I'm going to explain the importance of having cash days. And what a cash day is basically a day where you take no trades. So I'll give you a quick little backstory. For me, when I first started trading, really before I knew what I was doing, I would be taking a lot of trades every day. Um, I would take sometimes like more than 10 trades in a day. I would be green on my first trade, and then I would think, oh, if I replicate this 9, 10 more times, I can make 10 times the amount I made on the first trade, and then I ended up giving it all back. But the idea behind what I'm trying to get at is that the less trades you take sometimes is the better. So not every trade is going to be worth your capital. And with that being said, there's some days where staying away is going to be the best thing that you can do for your trading and your account. So let's just get into the little slideshow I have right here. One of the first reasons why having cash days is important is because you're really optimizing your risk management. So, like I said, not every trade is worth taking. So my first point here is you won't consistently find A plus setups every day of the week. Um, there's gonna be trades where you might want to size down. So that goes with my next point. But then there's also gonna be trades where you should just completely stay away and stay cash, just let it play out. Because if you look at trading, if it's a probability game and it's a risk management game. So if the trade isn't really highly probable, your risk to reward isn't too good on it, then you should probably not take the trade. Just because why would you risk, for example, $100 on a setup that's C grade or even D grade, while you're also risking $100 on an A plus setup that has a much better risk to reward. So with that $100 risk on a good trade, you might make 2 or 300, versus the bad trade you might make 20 or 30. So that's my first point, is that you're not always going to find those A plus setups, and there's going to be some days where there's not even B grade or even C grade setups worth taking. So those are the days you should be risk off, kind of let the market play out. If something sets up, then you can consider it, but you don't want to just be forcing a trade just because nothing's going on. So the way I see it, or the way I try to tell myself how to take less trades, is if I'm already agreeing on the day, would I take the trade that is right in front of me? And that allows me to have the discipline to kind of sit out of certain trades. So, being cash, you're going to want to take a trade most of the time. A lot of people are inclined to want to get into something rather than stay aside. However, staying aside is just as much of a decision as getting into a trade. So sometimes skipping the trade is a better decision than actually getting in a trade that's not that good of a setup. So my next point here, my last point, you only want to allocate risk towards highly probable setups with good risk to rewards. So I kind of explained that. You don't want to just be throwing money at whatever setup really comes to your desk. You want to really stick to the good ones, so that your risk management and you're really optimizing your trading strategy. Now my next point here is basically about overtrading. So like I said, I used to take a lot of trades in a day. Now, since I really narrowed down my entry criteria, I'm taking much less, and with that I have a much higher win rate, since I'm looking for more things to really tell me if it's a good trade or not. So what I said here is when you stick to 1 to 2 trades in a day, your entry criteria is very strict. And with that, your entry criteria is not going to be met every single day of the week, every single day of the month. You might have a couple cash days every month, and those are usually the days where you'd be better off being cash, where maybe the market's not moving right. Maybe your stocks are just stuck in a bad area, so it needs to set up a little bit longer. So when that's happening, it's better to wait and let things kind of set up for you than to get in something prematurely when it's not really a good setup worth your capital. So my next point is sometimes people feel bored, and that if they don't take a trade every single day, then that they didn't do well that day. I kind of explained it a little bit, but people definitely in the beginning, you're going to be more inclined to want to take a trade than to want to be cash. But like I said, sometimes it's a harder decision to actually sit cash. However, that's probably the decision you should be making. So, kind of similar to the first point, you want to make sure your entry criteria and that the setups that you're trading are actually good setups. They're not just anything that you're seeing on the desk. So, for example, let's say you have 4 or 5 points of confirmation to get into a trade, and that's your typical day. You see a bunch of things working for the trade, so that's where you allocate your risk. Now, let's say it's a slow day, and then you see just one thing happening. Is that going to be enough for you to get into a trade? And especially if you think about it, if I'm already green on the day, would I take this trade? You probably wouldn't. However, when you're just bored sitting in front of the market, you might just say, all right, something's working here, so let me just get into this trade. However, the strong disciplined thing to do is to sit aside and wait for it to actually set up for you. Wait for your different entry criterias to actually hit for you to get into the trade. So another point, on slow days, you will probably be forcing trades rather than having your trades come to you. Similar thing, you want your entry criteria to kind of happen. You don't want to be forcing it. You don't want to be getting in early. You want to just make sure you're sticking to your strategy, sticking to the right risk management, and then not trading on emotions. So a lot of these points, at least in this little section, is all emotionally driven. Either you're bored. The last point I have here is FOMO. That's all just emotionally driven. But if you disconnect from that and you know what your rules and principles are, then that alone is probably going to make you have some cash days, just because not every day will all of those different things hit for you to actually get into a trade. My last point is avoid FOMO. So let's say, for example, you're in stock hours, and let's just say the whole chat made 20% on a trade. However, that trade wasn't something that you liked personally. Be happier that you stayed aside and stuck to your personal rules than to get in after the whole move happened just because you see everyone in the chat is up, or just because you see the stock shooting up, you get into calls. That's not the right thing to do. It's not the right way to go about trading. You need to have your rules and principles and really stick to them, and then over time you will get paid by doing that, as long as you have obviously a profitable strategy. But when you start breaking rules, like just getting in because the market's going up, then usually in the long term it's not going to work out for you. Another point I have here is overall market sentiment. So that's basically what the overall market is doing, and then also on bigger time frames. So if you look at the daily chart, sometimes the entire market is just consolidating. So if you're a breakout scalper, there's usually not a lot happening in those times. So my first point here is markets are ever changing, and your strategy might not be successful in every market's price action. So if the overall market is consolidating for, let's say, a month straight, it's going to be a little bit tougher as a breakout scalper, just because, if the market's flat and then you make money when the market goes up or down, then obviously it's a little bit harder. And in those times, that's where you want to have more cash days. You want to, put risk out when the market is doing what you want it to do. So if you're a breakout scalper, you want to see moves to honestly either direction. If it's flat, then that's when you should be a little more risk off, wait for things to set up more, and when it does set up, then you could put risk back on the table. But if you're putting heavy risk out there when market conditions aren't good, your win rate might not be as high in that specific market. But now let's say you're a reversal scalper, you might, or just a reversal trader, not scalper. You might do better when the market consolidates versus when it breaks out. So it would be basically the opposite in that example. You would be more risk on a flat market, since you're doing reversals, than you would in a trending market, or just a breakout market. The other point I have here, learning different strategies can help you adapt to new markets. So just like I said, this year, 2023, I personally learned more about reversals. I used to only do breakouts, and then I learned about reversals, and then through that, it helped me even more with my breakouts, breakout scalping. So don't completely change your strategy, but learn how you can tweak it to adjust to the market's changes. So that can be adding a strategy on top of whatever you trade normally, or it can just be making slight tweaks to your actual main strategy so that it can fit different type of markets. Or maybe, if the market's flat, you might want to be more conservative on your trades. Don't let it run as long. Just take the quick scalp versus a longer hold. So, learning different strategies, learning how to adjust your strategy in different markets is going to be pretty beneficial for you to stay consistent through all market conditions. And I think this is my last point. Cash is a position. So anytime you hit buy or sell, you're making a decision based off of what the charts are telling you. And being cash, not taking any trades, it's the same thing. You're making a decision based off of what the market is telling you. So you're going to be skipping out on some trades because the market is showing you that it's not worth your risk. So my first point here, you have to make the conscious effort to skip out on certain trades and remain cash. So just like I said, you have to be disciplined and stick to your strategy to not just take anything that comes across your desk, but to take what's worth the risk, what's a good setup, what fits your strategy, and your rules and principles. And my last point here, being break even on a trade is better than taking a red trade if the trade was not a good setup. So sometimes taking a red trade, there's nothing wrong with that. If you stuck to your entry criteria, everything told you to get into the trade, it just didn't work out for you, that's better than you getting into a trade that doesn't fit your entry criteria, that you totally broke your strategy, your rules, but end up being green. Because in the long term, if you're consistently breaking your rules, there's a good chance that you're probably not going to be profitable. But being break even on a trade, on a bad setup, for example. So let's say it's a D grade setup that comes. You have to decide if you want to get in or not, but it's honestly a D grade setup, so it's probably not worth the risk. So you're gonna skip it. That's better than you getting into that trade that's just not really worth it and being green, because it's going to tell you that it's okay to break your rules, okay to break your principles. However, there's a reason you have those in place. It's because in the long term, that's how you're going to be profitable, is by sticking to this strategy. So when you start breaking it, that's honestly one of the worst things you can do for your mentality, and your discipline especially. So, staying cash, it's going to be hard for some people sometimes, but the long term, it's going to be one of the best things you can do for risk management and your account's overall growth, because it's forcing you to stick to the actual best trades that come to your desk, and those don't come every single day. So that's why having cash days is very important. It takes practice to be disciplined enough to not take a trade, but hopefully you guys get there. And sometimes I know there's some traders that take a lot of trades in a day and they're profitable. So just for example, let's say you take 10 trades a day on an average day. Just because that's where your strategy is, that's not mine personally, but for example, having a cash day is going to be very hard, because that's a lot of like, it's a lot less. For me, I take generally like 1 to 2 trades in a day. But if you're taking 10 trades on an average day, having cash is probably not really so realistic. But if you went down to 2 or 3 on a bad day, then that's a good thing, because that means that you're staying disciplined to your trading plan and your strategy. So so basically it's all about sticking to your strategy. Don't break it, and don't force anything on the slower days, because that's usually where a lot of people have pretty big red days. They're just not trading what's really in front of the desk. But hopefully you guys enjoy the video. That's it for me today. Make sure you guys like, subscribe, and join Stock Hours. We want to see some more members in there. All right, peace.